If someone offers you a choice between a 15% return and an 11% return, the math seems obvious. 15 is larger than 11. But if securing that 15% meant gambling your entire net worth on a single penny stock, while the 11% came from a guaranteed government bond, the choice flips. The raw numbers hide the actual cost of the investment. Generating a high return is relatively easy if you are willing to accept total financial ruin. The true challenge in modern finance is accurately defining and measuring the risk you take to earn that money. In 1952, Harry Markowitz introduced a rigorous new framework. You cannot evaluate an asset in isolation. You have to measure how it affects the risk of an entire portfolio. This insight led to Tobin's two-fund separation theorem, which reduces investing to two distinct decisions. First, identify the single optimal portfolio of all risky assets, the broader market. Second, decide how much safe cash to hold alongside it. This chart plots expected return against total risk. The diagonal path connecting the risk-free rate through the optimal market portfolio is the capital market line. Your risk tolerance dictates your position here. Slide left holding more cash, or right borrowing to buy the market. Under this theory, a rational actor simply buys the market and adjusts their leverage. To figure out what a single isolated stock is actually worth, we need a completely different mathematical tool to compare it against this universal baseline. This diagram shows how the total risk of any investment breaks down into two distinct halves: systematic risk and unsystematic risk. Unsystematic risk is company-specific danger, a sudden CEO scandal, or a localized supply chain failure. If you hold a highly diversified portfolio of hundreds of stocks, these isolated events cancel each other out and the risk disappears. Systematic risk, however, is the macro environment. Global interest rate hikes, recessions, or inflation affect the entire board. You cannot hide from it through diversification. Because unsystematic risk can be so easily erased, the market refuses to pay you for it. Investors are only compensated for enduring the unavoidable, systematic risk that impacts everyone. To isolate how much systematic risk an asset carries, analysts use a measuring stick called beta. It tracks how intensely a specific stock moves in relation to the broader market. This gauge visualizes the beta scale. The entire market sits exactly at 1.0. An aggressive tech stock might have a beta of 1.5, swinging more dramatically than the market, while a defensive utility company might sit safely at 0.5. Using the Hamada equation, analysts can strip out the artificial volatility created by a company's debt, leaving behind its pure, unlevered business beta. Once we have that beta measurement, we plug it into the capital asset pricing model, CAPM. This equation converts that precise level of systematic risk into a required rate of return. This graph plots the exact math of the CAPM equation, placing beta on the x-axis against expected return. The resulting diagonal slope is the security market line, and every perfectly priced asset in the world sits precisely on it. CAPM establishes a non-negotiable threshold. It dictates the minimum exact return an asset must provide to justify the specific market risk you hold. With this mathematical pricing baseline established, we can evaluate professional portfolio managers and expose whether they possess genuine skill or if they just got lucky by taking hidden bets. If you are looking at a standalone portfolio that represents an investor's entire wealth, you use the Sharpe Ratio. It measures excess return divided by total risk, including all that messy, unsystematic noise. But these two formulas show a vital distinction. The Trainer ratio on the right divides reward solely by systematic risk, beta. This makes it the standard tool for evaluating a specific fund held within a larger, diversified portfolio. If a portfolio shows massive raw returns, but a poor Trainer ratio, the math reveals a harsh reality. The manager is taking on dangerous, unsystematic risk, and the market isn't paying them a dime for it. To isolate true financial skill from general macro tailwinds, analysts use a final metric known as Jensen Alpha. Looking back at our security market line chart, we see a data point hovering above the diagonal. That specific vertical gap between the CAPM required return and the actual return achieved is alpha. Generating a positive alpha mathematically proves that a manager produced excess returns completely independent of the broader market risks they rode. Modern portfolio theory demonstrates that successful investing does not rely on blindly chasing the highest raw percentage. It relies entirely on the precise optimization of compensated risk.